Okay, so now we are on part 2 of the recording and now the primary focus is chapter 14 for this lecture. I may stop the recording every 50 minutes and then divide that into the parts. So chapter 14 is focused on pricing decision. So for companies, it is important as aspect because all we have done so far is always focus on cost, and we didn't talk much about pricing. So the company has a process of setting up the pricing. So there are different strategies the company use when it comes to setting the price of the product to the customer. So here are the 8 different learning objectives that we are going to go through in this lecture or in this chapter. First, we're going to look at the different pricing strategy companies has, and first we're going to start with the cost-based pricing. Then we're going to look at the market-based pricing. Then we look at the limitation of both the methods as what is good and what are the limitations for one or the other. And companies will pick depending on what the company's situation is. But there's a limitation for both of them. There's a benefit for using both of them as well. So we'll look at it and understand what are the limitations for both cost and market base if the company decided to one or the other. Then the other concept, we're going to look at the elasticity of demand and how does the price changes the demand of the product, whether the price is elastic or not, and we'll talk about what is that and why is it important for the companies. Then we look at the additional factors that exist. Then we look at the transfer pricing. Then we look at the different limitation the companies have when they look at the transfer pricing of charging from one company to another within the organization, and some of the other factors that are important when it comes to setting up the transfer pricing. The first thing that we're going to look at the different pricing methods and how we calculate the price using each of these methods. The first one we have is a cost-based pricing model. So in all the chapters that we have looked at so far, we look at the cost. So we know that the cost of the product or the cost for the company is kind of divided into 2 parts. One is the manufacturing cost, which include your direct material, labor, and overhead. And then we have non-manufacturing cost, which we also call period cost. And those are combining both of these costs are the total cost of the company. So now what we do is when we use a cost-based approach, the company will decide whether they want to cover the variable costs or whether they wanted to cover all the manufacturing costs, or the company wants to cover all the costs, which includes manufacturing and non-manufacturing, and add a markup to that cost to determine what the price of the product is going to be. Okay. So the first question that the company will ask is, what are the costs that the company wants to cover? So if there's, let's say that the company say, okay, I wanted to cover the variable cost. So the variable cost of the product is, let's say, $80 per product or per item, and then it will add a markup. So in that case, the markup will include to cover the fixed cost as well as the non-manufacturing cost. So the markup for that base may be too high, so that way it has to capture all the fixed costs and the non-production costs as well. But if the company decided that the cost that they will cover is the variable and fixed, they will include that and then add a markup to that cost. The other strategy company will use is that they will cover all the costs. So if the company is producing only one product, they will look at the variable cost, they look at the fixed cost, and they look at all the non-manufacturing costs, which includes the selling and admin cost as well. And then they will add a markup on top of the cost to see what the price of the product is going to be. So in that case, the markup may be lower because it's only capturing the profit that target profit that they wanted to get out of the company's revenue. So either approach is acceptable. So the company can use any of these methods and determine what the markup is, and that dictate what the price is going to be charged, or the price will be determined for the product. So the next question, so we're not going to get too much into the cost as how the cost is calculated. So in this particular question, the cost most likely will be given to you. Say, okay, well, this is the material cost. That includes the direct material, any shipping or any other cost. That all be given to you guys, saying this is the cost of the product, this is the cost of the labor, this is the manufacturing overhead, and so forth. So those costs are covered depending on what strategy the company is using. You will add all of that. The next question is, what is the markup is going to be used? So sometimes the question is straightforward. They say, okay, well, the markup is 10%. So whatever is the cost, you add the 10% markup, and then that will dictate what the price of the product is going to be. If the markup is not given, the company may have to determine what the markup is going to be. So the book talks about the markup in 3 different ways, so you guys can go through that. But here I can simplify that for you. Is the markup is how much profit you wanted to get out of that product. So let's say that the company has an investors, and the investor is expecting a rate of return at 10%. So what you do is you look at this cost that the company decided to use plus the target profit. So you add the target profits, let's say 10% or 5%, into the cost, and that will dictate what the price is going to be. In some cases, if it's not looking at the rate of return, they say, okay, well, we want the profit to be X amount. So they simply tell you how much profit the company wants to earn. So what they do is they look at the profit and they add it into the cost and look at how many units they're going to sell, and then determine what the sale price is going to be. Okay, so you can calculate the markup based on the target profit or the return or rate of return the investor is expecting. Okay, or if you have the information from last year using absorption costing or the contribution margin income statement, you can look at what the profit was and how much profit they wanted to earn this year, add that 5% or 10% into that, and that tells you what the estimated profit is going to be for next year, and you can use that to determine the price for the next fiscal year, for next period. Okay, so the markup is debatable, but again, it all depends on what information is given and what the company strategy is, and you add that profit into your cost, and that considered to be the basis for your cost-based pricing model. So the 2 important things that you don't want to forget is the time and material pricing. So one thing that you wanted to do is, when you're setting up the cost-based pricing model, is you wanted to look at the timing of the product. So the product that you're looking at right now, it may have a different prices in the future. So if you're looking at the direct material, you're producing today, but you're going to be selling it in the future. So you might want to look at the pricing as what the material cost is going to be based on when you are doing the production. So the timing of the material pricing is important. The second piece is the completeness. So sometimes what happened is maybe companies may forgot to include small things, such as we look at the direct labor cost, but we forgot that the labor is also getting benefit. Okay, so that benefit has to be included when we determine the labor rate. Okay, so anything that you have that's part of it, it must be included and must be factored in when you're looking at the cost method. Okay, so any information that we missed, it ended up with calculating a misallocated cost. So any material cost, if you have a shipping cost or you have handling cost, or if it's like a tariff that the company has to pay, like there's a lot of things that are happening between US and Canada. So if there's a tariff that comes into place, so you're gonna have to make sure that that is also factored in when it comes to the calculation of the cost base, that this is factored in. So now think about it, if the new tariff comes in between US and Canada, and the company is using a cost-based pricing model, that technically means that the price of the product, that if US is buying that product, the company who is selling that to a US customer, the price of that product will go up if they're using a cost-based pricing model. Okay, so all those factors need to be considered when these pricing are being calculated in using that strategy. The second approach we have is a market-based approach. So the market-based approach is not looking at the product cost, but it's looking at the market. So looking at the competitors as what the other competitors are charging for the similar product that the company is going to sell. The second thing they look at is they look at the customer demand. Say, okay, well, if I launch this product at X amount of price, what is the reaction for the customer? Is the customer is going to be happy with that price that I'm going to charge? They look at that factor as well. The other important thing that the company look at the market-based approach is the sensitivity. If the customers are very sensitive with the price, so the company may decide to use a market-based approach because they don't want the customer to react differently. So therefore, they will use the market-based approach. So three things that are important for the market-based approach is that the company has a competitor, which is close competition, or the customer, the demand is the market-based price are, there's driven on the customer demand, that the customers are very sensitive with the product. So in that case, the market-based approach will work for the customer. So a good example that I have for you guys is all of you guys use the cell phone. Some people may use iPhone, some people may use Android. So the Samsung and Apple, they are good competitors with each other. Okay, so when they launch a new product, they want to make sure that the price is very competitive with the other cell phone companies that are selling the similar product. So in that case, know that the competition is there and the customers are sensitive with the price. So therefore, when they launch a new product, they have to make sure that the product is within the price range. If they ever come with the price of the product either too high or too low, then they have to differentiate themselves from the product. So whenever they use a market-based approach, it's important for them to differentiate as what they say a price is going to be, because they need to say, okay, well, if they're charging more, what are the features they're bringing to the customers, so that way the customer will not react that much because they are very sensitive with the price. Okay, so these things plays an important role when they're using market-based price. Other factors that are important for setting up the market price: companies sometimes use competitors' pricing to establish their own market. So it is important. Sometimes what happens is when there's a new product being launched, what they do is they set up a price, or they use the competitors' prices to establish their own market. So if the company is charging at a certain price, they bring their own product within the price, so that way that they can capture, or they can promote their product in the same market and get some market share. The internet makes it possible to learn about the market price. So now these days the information is readily available to the companies. So if their information is available, so they can easily look at what are the competitors that exist and what is the prices that they're charging for that similar product, and based on that they can determine what the average price is and what they wanted to launch for that new item that they wanted to introduce in the market. The internet and global competitors have forced an increasingly large number of organizations to use market-based approach. So now these days the information is readily available due to the social media and ease access of the information, not just within the local industry but in a global industry. So in that case, when you're launching your product, you don't have to worry about you don't have to only look at the domestic market, but you have to look at the global market. So that with that information, you can easily look at it, say, okay, well, what is the average price charged for a similar product that's in the market? How many competitors are there? You can easily get that information, and based on that you can create your own strategy of what the price will be and what feature you're going to be put into the product and how you can differentiate that into the market as well. So you can use that information and then have capture some of the market that already being taken by another competitor or your competitor. So ease access of information promotes using a market-based approach. So each of these methods has its own limitation, and some of the major drawback that for a cost-based approach is simply ignores the customer demand. So the cost-based approach is an easy method that the companies can use because they already know the cost of the product. All they have to do is look at the cost and just add a markup to that cost, so they know that they're gonna get a granted profit from that product, but they ignore the market. So if they ignore the market, that means that this could impact and this could cause a death spiral. Okay, what is death spiral? Means that if you ended up picking up a wrong price, that you're going to charge to your customer. So all of a sudden what's going to happen is that the customers say, okay, well, this is too high for the price to pay for the product. All of a sudden you're going to lose the demand, which ended up that you're not going to sell the product, and it's going to end it up in not impacting the volume. That means that you may have to bring your price down and may ended up losing the profit as well. So it could put your companies into the downward demand, and then it will eventually affect your revenue and eventually impact your profit as well. The major benefit, as I already mentioned, using cost base is a simple method. You look at the cost and you simply add a markup depending on the information that you're given or the target that's set up by the company. Using a market-based approach, estimate the revenue, managers make better decisions. So that's an advantage of using the market-based approach, that you're using an estimate based on the market. So you can easily estimate what the volume of the product that you're going to sell for the X amount of price that you're going to charge to your customer. But the same thing that also impact the drawback as well, because you don't know the relationship. So you're still estimating the market demand. So the price is always difficult to estimate, because you know what's in the market, but you don't know what's coming in the market. So when you estimate a price based on the current market, what if the other product comes into at the same time or a little bit later? That may impact your product demand as well. So even though it isn't a good estimate, but it still can backfire the company as well. So you have to be prepared and then have some kind of a margin in the pricing strategy when you're using the market-based approach. The other thing that's not mentioned in this PowerPoint, but I think it may have mentioned in the book, but I think it's an important, when you look at the market-based approach, you simply ignore the cost. Okay, so when you're looking at the market-based approach, you're setting a price based on what the other competitors are charging, but you have to keep in mind is that you have to consider what the cost of the product is. If your market-based price is too low and that's not covering up your cost, that's also not good for the company as well. So in a market-based approach, you have to work backwards. If you're setting up the market-based price, you have to look back at the cost as well and see what the cost of the product is going to be as well, to make sure there's at least a minimum profit that you're earning from the product as well. Okay, in this case, when you have higher cost and your competitor price is based on the market price, then you may have to bring back your cost down to create a profit that you wanted to achieve from the product. Okay, so I'm going to stop the video here. So this will be the end of part 2 video. And the next part, we're going to talk about the other 3 learning objectives that we have.